In most of the finance courses, scenario analysis is taught in a very basic manner, wherein you have bear scenario, base scenario, and bull scenario. And under each scenario, you have 5 to 6 variables only which are changing. And you observe how the output changes. That's useful at a beginner level. But in corporates, especially in corporate finance, FP&A, and investments, the main question is not only that what the output is under bear scenario, base scenario, and bull scenario, but also how should we design the entire scenario architecture inside the financial model. Because if your scenario structure is not designed properly, then the model becomes difficult to update and difficult to audit and also risky to use for decision making. So in this video, I will explain two professional ways to build scenario analysis in your financial models. The first method is centralized assumptions approach, wherein you have all of the assumptions in one single tab under each and every scenario. And then you simply use a lookup logic to pull the assumptions into your financial model so that the output changes accordingly. The second approach is dedicated scenario sheet approach, wherein you have different tabs for each and every scenario, and the model dynamically switches between those sheets. By the end of this video, you will not only learn advanced functions such as indirect address and how to use indirect address in a multi-tier scenario, but you'll also understand the thinking behind which scenario architecture to use in which type of financial model. Now, before we dig deeper, please remember that what I'm about to show you is a proper scenario engine with strong model governance. So coming back to first method, which is centralized scenario assumptions approach. The philosophy behind this structure is very simple. Have a single sheet for all your scenario assumptions. Think of it like a mini database inside Excel. As the name holds true, there is a central assumptions tab known as scenarios. If you see, these 3 years are the historicals, and then these 5 years projections related assumptions are for bear case scenario. Then the next 5 columns are for base case scenario assumptions, and then the last columns are for bull case scenario assumptions. And if you look at this, each and every line item has a same level of assumption detail across all the scenarios. If there is count of additions for assets, it's the same across each and every line item. However, the assumption might differ based on whether it is a bear scenario or base or bull. And if you look at this, this is the total revenue related forecast. And then after that, we have direct cost related forecast like manpower cost, then salaries, and we also have staff insurance, bonus provisions, which are also considered as part of the salaries. Now we also have raw materials and consumables. We have fuel expenses based on the mileage and the efficiency of the truck, the fuel escalation prices. We have insurance as well. We have property maintenance expenses. Then we have marketing expenses, office facility, G&A expense, capex additions are also there. So if you look at capex additions, there is additions to heads, which is the truck heads, and then there is additions to beds, which is the flatbeds. And the total of this is equal to the total new assets that are bought. So each and every, the line item level structure is same. The only thing different is the value of assumptions. Now, once you have this kind of structure in place, the critical thing is then only the lookup logic, which has to be multi-tier. So we can pull those assumptions here. Now, right now, the selected scenario is bull. And if you look at the formula, it's a very simple formula. So the formula is this. What we are trying to do is that we are trying to put the entire data in an array from A to AE. That's the array that we have considered in the function. And then we are trying to match I111, which is this. This we are trying to match against column I in the scenarios tab, which is the label. So this is the label match. And then we are trying to match the column on the basis of two things. First is the year that is there, and the second thing is basically the scenario. If you look at it, it's selected as Q8. So that's the scenario. All we are trying to find is the value of this label against the relevant scenario that is selected by the user and the relevant year in which it will fall into, which is what we have done here. So that's how it is modeled in this entire PNL. Even if you look at the logic of capex and everything is exactly same. If you look at fuel cost, same thing in fuel cost as well. We are trying to focus how much each truck will travel, what is the total distance that it will travel, what will be the fuel price based on its efficiency, and then we are also knocking off a certain overall fuel efficiency factor to arrive at the fuel cost that would be consumed by the entire fleet. Same way we have done insurance expenses, which we are forecasting it on a per asset basis. Then we have property maintenance, we have marketing expenses, and then we have the gross block as well. Even in the gross block, we are trying to build in scenarios, because a bull scenario would indicate to the management that the management would want to expand their capex base heavily, whereas in a bear scenario they would want to keep the capex expansion to a limited levels. So that's what we have. All of these assumptions get factored into the P&L and balance sheet. However, for this exercise, I have not drafted the balance sheet, which can again be drafted in a similar way. And then we have created our valuation, which is pulling all of the relevant numbers from the model. And based on the selection, the valuation changes. If I select here bear case, my valuation drops down to 1811. If I select bull case, my valuation increases to 2430. Now let us also understand quickly the advantages and limitations of this approach. One of the advantages is that all of the assumptions are centralized and are available at one place. So the review is quite easy and quick. The other advantage is also that the model will have an easier audit trail. If you have to audit certain assumption or a certain scenario logic, auditing becomes easier in this approach. It also works extremely well when the scenarios have similar line items. If you are forecasting the full P&L, the full balance sheet at each and every line item or most of the line items, which are going to be same across all the scenarios, then this scenario approach works extremely well. Let's move on to limitations. One of the biggest limitations is that it becomes very difficult to model the scenario if each and every scenario has a different line item. So what I mean to say is that each and every scenario assumptions are at different line item levels. Then this approach would not be well suited. Another limitation is that sometimes the scenario blocks can become wide. Like let's say if you are analyzing 5 to 6 different scenarios, which is very common in certain types of models. So in that case, using this type of structure will be bit difficult in the models. And another limitation is that in case you have to add more years, then the overall structure of the model has to change. So adding new years or any new block within this entire array may require structural changes in the model. Also, sometimes debugging can become slightly difficult if too many match conditions are used. So conceptually, this behaves more like a mini database architecture rather than your traditional spreadsheet approach. Now let's look at the second approach, which is dedicated scenario approach. And this approach is more dynamic from Excel engineering perspective. Now, instead of having one single sheet with all of these scenario assumptions, we now have different sheets for each and every scenario. So here is the base scenario sheet where you have the historicals and then you have the 5-year forecasted assumptions. So here you have the 3 years historicals and then you have the next 5-year projection related assumptions for bear case scenario. Similarly, if you go in base case scenario, you again have the assumptions related to base case scenario. And similarly, bull scenario also has the assumptions related to the forecasts. Now, the logic and the philosophy behind this would be that whenever a user selects bear, bear assumption should flow into the model. Whenever bull is selected, bull assumption should flow into the model. So this kind of approach can be used with this indirect address function, which you are seeing here. Now, for those of you who don't know this formula, let me just explain you in one single minute. If we select any sheet, let's say bear, and we say this cell Q12. So this is basically bear Q12. I can also write the same thing as bear Q12 and it will still work. The only difference between quotes is that if there is space in the sheet name, then quotes are to be used. Otherwise, the Excel doesn't require quotes to be used for referencing the sheets. Now what happens is we are trying to find out this only with the help of this function. We are saying indirect, and then inside that we are giving one single quote for the, because there could be any sheet where there is a space, right? So we are trying to make it fully dynamic. So we are giving single quote, and then we are saying AE11. AE11 is nothing but the scenario name, which is bull. So bull name will be pulled here from the cell, which is dynamically moving. And then we are giving another single quote and exclamation. If you see here, another single quote we have given and an exclamation. And then all we need to find out is the cell reference, which is on which row and which column. That's all we need. So in this case, we are using here address function, because whenever we are using the sheet that is not being used, we need to use address function in that case. So here we are saying address, and then in order to get the row number, we are using a match function. And here what we are saying, match I94. If you see, I94 is nothing but this label. This hash of new truck additions is the label. And then we are trying to find the column in which row it exists. And then we are asking it to give an exact match. You must see that I have used numbers here, 1517. Why? Because if we give the full column reference, then the formulas might take a little longer to compute. So this is one of the best ways to reduce the computational speed, wherein you just give 10-20 times more the range, but don't give the full column. So if I know that my assumptions are going, let's say, until 500 rows, so I will end up giving the range of, let's say, 2000 or 2500, just so that the computations are reduced. And then we are trying to match the column. Now in column, again, we are saying that we are trying to look at which year, which is FY26, and then which rows. If you remember, 7th row is the year row. And then we are saying, give us an exact match. That's what all we are doing. And this exactly amounts to the same number, which will come here. So this is basically pulling from bull. So if I just write here, bull, and this is the value. Now, if you would have noticed that in this function, I am still using base, right? And here also base. The reason why I'm using is because I know that all the sheets are standardized. Now, if the sheets were not standardized, then we cannot use this formula. Then we should have used this formula. I didn't show this earlier because I wanted to explain the concept first. So if you see, this is the additional formula that it will be. So if I just copy here and paste it, it becomes the same formula. So now what exactly this function is doing is the concept still remains the same. It is giving the quotes and then trying to find out what this number is, as in which scenario is selected, which is again bull. And then within address, it is trying to find the label I94. Now it is going to refer that specific sheet. So I've given this label because this means that it will go to that specific sheet. AE11, it will go to bull sheet. Again, single quotes open, bull, and single quotes closed, and exclamation, and then the range. Within that range, it will try to find this label. Same goes here. It is going to look up at this year and try to find in the bull sheet at row 7. Now this formula is fully dynamic, and based on the user's selection, the values will move. So that's how we have modeled this scenario. And if you look at the valuation scenario of second approach, we have 2430 in the bull scenario, which was same as option 1 or method 1. We select base, we get the valuation as 2030. And in case of bear, we get 1811. Now, if we look at the first approach that we had discussed earlier, which is this one, 2430 bull, base scenario as 2030 and bear scenario as 8111. You must have observed that I have not used normal data validation. Use the radio buttons here, which is here, to demonstrate the scenarios. This way it looks more cleaner and more presentable, and the executive management can play with the model scenarios as and when required. So now let us also look at the advantages of second approach. The first advantage is that there is a very clean and a visual separation in each and every scenario. As each and every scenario has its own dedicated sheet, so it becomes easier to review scenario by scenario. And it's very much flexible if scenarios have different assumption structures. Like I said earlier, if the line item levels are different for each scenario, this is the best approach that is out. And sometimes when you are having discussions with the executive management, this kind of structure can also become very helpful, because then each and every scenario can be reviewed separately. Now, there are some limitations also of this approach. So one of the limitations is that indirect function is little bit volatile. By volatile, what I mean is that every time a calculation is done in an Excel, the indirect function will recalculate it again. That's one of the slight limitations, that if your PC is not up to the mark, maybe if you're using an i5 or earlier versions, then in that kind of scenario, the Excel might struggle to run these kind of structures smoothly. Now, another limitation of this approach is that it is slightly less audit friendly and may create issues with external links. Also, the formula debugging can become a little bit of a nightmare if you don't have good grasp over indirect address functions. However, that said, with all the advantages and disadvantages, this approach is elegant and dynamic, but it should be used carefully, because flexibility also comes with auditability and performance trade-offs. Now, which approach to use when? In simple terms, if you have same assumptions across all the scenarios, meaning same line items levels across all the scenarios, and you don't have more than 4 scenarios, and you don't have more than 5 years or 6 years, then you can go ahead with centralized scenario sheet. Why? Because at the end of the day, it will give you 6 cross 4, 24 columns max, which are still easier to manage. But if the data is monthly and still there are 5 or 6 years, don't go for centralized scenario approach. It will be nightmare to evaluate it. Also, if the model is a simple model like an equi-search valuation model, then go for a centralized scenario sheet. And also in cases where you require strong audit, or where there are multiple team members working on a single model, and if the requirement can be satisfied with centralized approach, go ahead with centralized approach. Now, when to go for dedicated scenario sheets approach? When you have different assumptions across scenarios, meaning there are different line items across each scenario. At that time, go ahead with a dedicated scenario sheet approach. Also, when you have large number of variables, it is always better to have dedicated scenario sheets. And whenever there is a possibility that new variables or new assumptions may come in later, always and always go ahead with dedicated scenario sheets approach. Note that there is no universally perfect scenario architecture. I have just given you few assumptions, but still the right structure depends on the model complexity, scalability requirements, and performance considerations. So the objective of this video was not to just teach you index match or indirect address. The objective was to show you how professional financial models think about uncertainty through proper scenario architectures. That's it for now. Thank you all.